All right, welcome to Talkin Investing. I am Tom, and as always, this is not financial advice. Today, I want to talk about CPI. The numbers came in this morning before the market opened. They were hot, as everybody is calling them, but I want to go through why I think they were not that bad, and actually, I think there's a chance we're going to rally off of this. So if you're new to the channel, remember to subscribe and hit the notification bell. Also, if everybody could please smash the like button, it helps the channel out a lot, and I really appreciate it. Lastly, if you want to support the channel, you can join the channel by hitting the join button and become a member. Members get some exclusive content as well as once a week a members only live stream. So we'll be glad to have you there as well. All right, let's talk about the CPI data. First, I'm going to show you how the market's reacting. Then I'm going to dig into the report a little bit. We don't need to go too deep into this. I think this is all going to make a lot of sense by the time I'm done. And I do think we're going to have a relief rally. Okay, I'm going to start on the big picture. CPI data peaked back in June of 2022. So that was now 4 months ago at 9.1%. So when you just look at the top line number, it looks like we've gone 9.1, 8.5, 8.3, 8.2. So that is trending in the right direction. However, it's all about expectations, and the last few reports have been worse than expected. I think when we dig into it line by line, you're going to see that actually the market's going to decide this really wasn't worse than expected. This is basically what we were expecting, and it has certainly already been built in to the pricing, in my opinion. So you can see the consensus was 8.1. So the market was expecting 8.1. We came in at 8.2. You know, that's a very small difference. It is a miss. So it's considered a hot number. People are always, secretly optimistically hoping we're going to have a beat. So to have a miss is not good. But let's go look at the numbers themselves. Okay, so there's a few different numbers here. The top line number, all items, 8.2%. Again, they were hoping for 8.1%. Then we have another number that is probably really even more important. All items less food and energy. So that came in at 6.6. That was up 0.6%. That was worse than expected as well. So you can see that matches last month was also up 0.6%, and that one was a miss too. So we've back-to-back 0.6% increases. That leaves us at 6.6% year over year. So that number was a disappointment. So the big numbers were a disappointment on here, but if we dig into this by a line item basis, I don't think there was really any surprising numbers in the data. So the first thing I want to go through is last month, obviously energy pulled way back last month. So that was really the only reason that the number went down at all, was because energy, and you can see, core inflation without energy and food has been on the rise. So this month energy was down, but not as much as it was last month. So that was a little drag on the system. Food was up 0.8. That's exactly what it was up last month. So really not a shocker there. Again, everybody's hoping these were coming down a little bit. So, even a 0.7 or a 0.6 would have been a step in the right direction, but that stayed flat. Okay, so utilities was up 0.4. So that is better than August. Piped utilities gas service was up 2.9. That's a little bit better than August, but that is still a bad number. We know this. Natural gas is very expensive right now, and that has not fixed itself at all yet. But that is not a shocker. I don't think anybody is surprised to see that number in this report. Okay, used cars and trucks was down 1.1%. Last month, it was down 0.1%, and that was the only non-fuel item that was down at all last month. So it was a straight miss from top to bottom last month. So you're going to see, that's why I think this month actually was a little bit better. This 1.1% is a much stronger than 0.1%. Apparel, shockingly to me, went up in August, 0.2%. So this month, that was down 0.3%. So that starts to make more sense. I think that number is going to drop a lot lower, but at least it's a negative, so it's trending in the right direction. We also had medical care commodities go down 0.1%. So that was another one that moved in the right direction. So there are a few items we're chipping away at. We're just starting to see maybe a turn of the corner, and it doesn't look like that. This was a miss compared to expectations, but you can see we've got some line items going down at last, and I do think that trend is going to continue. Shelter up another 0.7%, so that's a total of 6.6%. That's a big number. That's hurting people. Transportation services up 1.9, so that was a miss for sure, and medical care services up 1.0. So not too many surprising numbers in here. Natural gas we knew is still a problem, so utility bills, electric bills, we know that the cost of living, shelter has gone up, rents are up, mortgages are up. So although this was worse than expected, right, we do have a target coming into this. This does not look like a disaster to me. Everybody, and I'll tell you the other thing, the past several times that we've gone into CPI, expectations have been high. Oh, we're going to beat, things are going to get better and we're going to have a great big beat. This time there was no such expectations, in my opinion. The market has been going down, and I think people have been expecting, hoping for the best, but expecting the worst. So the expectations were significantly lower coming into this. Now, we did miss, so the knee-jerk reaction was way to the downside. But I'm going to look at where the markets are at, and they've actually come off of their lows from first thing this morning. Everything was at its low at the open. It has recovered since then, so we'll see if that trend continues and we start to move to the upside, or if this is just a little bit of relief this morning and we're going to head back to the downside. But I think we hit the bottom at the open this morning, and I think people are going to digest this and realize this is really basically exactly what they expected to see. So I'm going to show you one more number that's more important than all these numbers, and this number is the main reason I think we're probably still going to be okay here. Okay, here's expectations for what the Fed is going to do. So you're going to see now 375 to 400. That represents a 75 basis point rate hike. That is now at 97.8%. So those of you who watch the channel know that I have said every day since the last rate hike, this next one is going to be 75 basis points. There was never any doubt of that, in my opinion. The market had a little bit of doubt, so I'm just going to review where that's gone from. If you look at the bottom, you'll see a month ago, about 50% of the people thought that we were going to have a 75 basis point. So from a month ago to a week ago, that turned into 75%. So most of the people by a week ago were already converted into understanding we're going to have a 75 basis point rate hike. So the market has already built that in. So yesterday it was up to 85 and today it's up to basically 98. So this is telling us really what we all already knew at least a week ago, really a month ago. So, 100 basis points is at 2%. I don't think that's going to get any higher. I don't think there's any real chance of 100 basis point rate increase. I think it's going to be 75. I think Chairman Powell has made it crystal clear for the last several months that that's what's going to happen. And now the market has this basically almost 100% built in. So because of that, there's really no more bad news to build in. The CPI data really is such a big deal because of this number. We're looking at what the Fed is going to do. Does that give them cover to raise rates, or does that put pressure on them to lower rates because we had a better than expected? Well, we didn't get better than expected, but they're not going to do worse than the worst they were already going to do, which was 75 basis points. So we have a total confirmation, in my opinion, of that at this point, with close to 98% built into the price in the market. So that's why I think we've got this built in. That's why I think this morning's lows were probably the lows. And, we may not have a gigantic market rally, but I don't see us cascading downward from here between now and November 2nd when the Fed comes out and does this rate hike. It'll be on that day that we'll see where we go next, and that will mostly have to do with the words Chairman Powell has to say after the actual rate increase. So in his press conference, we'll hear what he has to say, but the truth is, I think we already know what's coming. They're getting very close to the ceiling of where they can go. So if I look at the major indexes, we're pretty early in the trading day. As I'm recording this, we're about an hour and a half into the trading day. So you can see just on these small charts right here, we opened at our absolute low. And as I look at the Dow, it's actually getting close to break even. That could finish in the green today. The S&P is now down 0.83%, but it was down significantly more than that an hour ago. The Nasdaq's down 1.5%. It was down over 3% at the market open. And the Russell's down 1.55%. So they've all rallied off of their lows. They're going a little bit sideways at the moment. We'll see what the rest of the day brings. This tends to agree with my theory that the number came in worse than expected. There was a knee-jerk reaction to the low side, but we've already in this short period of time processed the fact that essentially this really wasn't worse than expected. This was roughly what we were expecting, and it has no impact on what the Fed is going to do. Okay, so quickly, this is the SPX on the 1 week time frame. So you'll see from our highs back in January until our lows of this week and really today, and we're off of our lows. You'll see there's a candle wick on this. This is a 1 week time frame, so we're off of our lows. But from the top to the bottom, this was a 27% downward movement. So I don't know where the bottom is. 27% is pretty decent down. There's been some talk about another significant leg down, but I don't think today's news is going to lead to that. We opened way down here, and we have a big green candle. So we are down on the day, but we are trending upward all day long wrong here so far. So the day is still early. We'll see what comes of the rest of the day. But at the moment, we're way off of the daily lows. And yes, we're still down from yesterday because we had a giant gap down at the open. But this to me is very good price action, all things considered. Okay, so this is the QQQ on the 1 week time frame. So the Qs mirror the NASDAQ. The NASDAQ's been hit much harder than the S&P 500. So you'll see from top to bottom, from the November highs until our October lows here. So that's almost a year. We're down about 37% over the last year. So that's significantly more than the S&P 500. But again, you'll see the same thing. You'll see we have a candle wick. We're off of our lows right now. And if I go to the 1 day time frame, you're going to see the exact same thing. We open with a giant gap down at basically the low of the day, and it's been a green candle ever since then. So yes, we're still in the negative for the day, but we have been on the move up all day long so far. Now, it is early, so a lot of things can happen. We've had a lot of volatility in the market, even intraday, so we'll have to see where this ends. But I feel like the market's probably going to level off a little bit. I don't think this was a catastrophe at all. It was a miss, and everybody's calling it a hot number. But when you break it all down, you'll see really, ultimately, the Fed's going to do the exact same thing that it was going to do anyway. So I don't really think that this had an impact on the market. And as for people's expectations, I think expectations were low coming into this. You know, we all still go to the grocery store. We all still fill up our gas tank, and we know things have not gotten materially better. I don't think anybody was saying, wow, things got a lot better this month. So I don't think that was the expectation. I think we're seeing that in today's price action. So we'll have to see how it plays out. And just to take a quick look at Bitcoin, this is on the 15-minute time frame. So you'll see this is when the announcement came out, a giant red candle. And you'll see the volume was huge. This is a 15-minute candle. That's one of the biggest 15-minute candles we've had in months. But you'll see that first 15 minutes, we bottomed out. We retested a local low, and we've pulled back up since then. So Bitcoin is behaving similarly to the markets. So across the board, it looks like we're going to be okay today. I would not even be surprised if some of these indexes ended up in the green today. We'll see. It could go the other way. Obviously, only time will tell. I don't think this CPI data did anything to change the Fed at all. And although it was a very slight miss, I don't really think it missed investors' expectations at all. So that's how I'm looking at the CPI data. This was the big number. This was the number. Had this gone horribly wrong, this could have tanked the market. Had this been a nice beat, this could have caused a big rally in the market. But really, we didn't get either of those things. We just kind of right in the middle. So we're not having gigantic action off of this, but it does leave the door open still for a potential relief rally going into the next few weeks. So that's all I got for you on CPI. If you made it this far, please remember to subscribe to the channel and smash the like button. Thanks so much for watching, and we will see you in the next video.